Well, we may have a few stragglers coming in, but I think we'll go ahead and get started. So welcome to Bartlett's 2017 Market Outlook. It's an understatement to say that 2016 was a year full of surprises, right? So while the dynamics of the market may have felt more dramatic last year, the reality for us is that managing through the gyrations of market movements is just an everyday occurrence. So as I look back on the year, I'm reminded of the most meaningful work that we do every day as guided by comments that I get from all of our clients. An example of this is a call that I received recently from Sarah, the daughter of a longtime Bartlett client. She's like many of our multi-generational families who we've worked with through world wars, recessions, financial crises, and many presidential elections, not just this past year. So Sarah called me as we worked through her mother's estate, and she said to me, "Kelly, I just need to tell you how grateful I am for the advice from you and your other advisors on your team at Bartlett." As Sarah thought about it, she said that it was really important for her that her mom, who was a pretty feisty and independent person, was comfortable later in her life. And so Sarah said to me, "My gratitude really goes back to that because during that time, you really helped us. My brothers and I gained a lot of confidence around your advice, and we knew then that Mom could remain independent during her illness." And the thing that really struck me at that time is that she said, "We were really relieved." And I know as parents, we want to know that our kids feel good about where our situations are. But certainly as children, it's really important that children know that their parents are comfortable during these times. So Sarah went on to say, "I want you to know that my brothers and I are going to stay with Bartlett. When we thought about it, your Bartlett team has worked with our family through many complicated financial matters for decades. And the peace of mind that you provided for us was really delivered with a lot of compassion and professionalism. And we want that same service, we want that same guidance and advice and care for our own families." Well, you can imagine I really appreciated what she said. She and her brothers all live out of state, and I know that they had plenty of investment advisors with whom they could have worked closer to their homes. So Sarah and I talked about the importance of long-distance communication. And she said, "My brothers and I were really happy about the long-distance communication. You know, my brothers are pretty tech-savvy, and they love the online portal. They especially were happy with the communications that we did with the video conferencing. And the video conferencing for them brought their whole family together when they were in these different cities. The planning," she said, "the planning that you prepared and implemented during Mom's extended illness, and then the individual financial planning that you performed for each of us individually was really critical in making decisions that were important and impactful to all of us." I've had many conversations like this with clients over the years, and they confirm for me what we strive to do every day to give you our best. It also confirms why we have a 98% client retention rate. It confirms why you, our clients and professionals who work with our clients in the room, refer your families, friends, and colleagues. And it also confirms for me why I am so very proud of my colleagues who are an integral part of this Bartlett team. So I'd like for all of them to stand now so you can see who's here today. This afternoon, you will hear from 4 of our advisors about the big picture concepts that inform and support our advice for each of our clients. 3 of them, Holly Mazzaka, Chris Robbins, and Brian Antonucci, will tell you the ways in which we believe the reality of populism impacts economic reality and our investments for this year. Now, if you attended last year, you may remember that we had a theme, navigating the noise. So to say that it was noisy is also an understatement, both in the political realm but also in our investment world. This year our theme is ready or not. Ready or not, because change is coming. So to kick off our discussion today, I would like to introduce Jim Haggerty. He will talk about how we successfully navigated a very noisy year last year. Now, for those of you who know Jim, you know that he's a pretty humble and understated guy. Well, right after the election, I was with a group, I hear some chuckles out there, I was with a group of community leaders. And because it was right after the election and they wanted to know, what do you think about the economy and the markets given the surprise election? And before I could say a word, one of them said, well, I really appreciate those emails that Kelly sends out. She gives me a lot of detail, but a lot of information that makes me feel really comfortable about what I need to be looking for because it's very informative. Well, I have to confess that I don't write those emails. But our next speaker is the author of those emails. He's a historian, a very savvy investor. I like to think of him as a student of the market, but also a very calm and steady guy, Jim Haggerty.
My charge from Kelly was to review 2016, but I'll go off the script a little bit, which may mean I won't be speaking next year. We'll see. But I'd like to take you back to September of 2013. In September of 2013, I opened a Twitter account. Twitter was it was a private company then, and they were going to have an initial public offering in November of that year, and so I wanted to know more about it. I thought, what better way to learn about Twitter than to open a Twitter account? And I wanted to develop some appreciation for this company and whether it would be investable and whether it might threaten companies like Google or Apple or other kinds of technology companies in which we were invested. So I opened up a Twitter account and I signed up to follow certain people. Unfortunately, Warren Buffett wasn't on Twitter, so I couldn't follow him. But after a while, I used it for a while, and frankly, I couldn't make sense of it. I thought, this is just a forum for sound bites. I don't know that I really see this going anywhere. And so November 6, 2013, Twitter came public in an initial public offering priced at 26. And the next day, the stock zoomed up past 50. It doubled on the first day of trading. It wound up closing at 45. And a little over a month later, on December 26 of 2013, it closed at 73. From an initial public offering price of 26, just 6 weeks later, it was 73. Now, it's been all downhill from there. If you followed Twitter at all, you know that the company really has not developed a way to make money, to generate revenues, to generate earnings. And from that high of 73 in December of 2013, it hit a low of 14 last year. And last night, it closed at 17. So I kind of smugly thought, well, my skepticism about Twitter was right. And one time last summer, I was playing golf with a friend of mine who's also a client. He works with Brian, who will speak later. And I recall him saying, I like these emails. Do you ever consider using Twitter? And I rather smugly said, when you don't get a tweet, you'll know it's me. Well, along comes Donald Trump. And while Twitter hasn't been an investment success, I want to share with you that I checked this morning. The Wall Street Journal has a total subscription base between print and digital of 2.4 million. USA Today, 1.7 million. Donald Trump has over 2 million Twitter followers. So it kind of puts into perspective, it hasn't been an investment success, but it's certainly reshaping our investment landscape, and Holly's going to talk about that much more later on. I have another reason for mentioning this. Clients have expressed satisfaction with the email messages that go out at different times during the year, particularly after times of great turbulence in the markets. But we're always trying to learn as a firm, and there may very well be better ways that we can reach clients. I've noticed, particularly in my own experience with the children and grandchildren of clients as we've begun working with them, that email is almost like a rotary phone. They don't use email, they're on to other things. And so I want you to know we're certainly very open-minded and very keen to have any suggestions you may share with us about other ways we could reach clients in a very timely way during times of turbulence in the markets. And you might even, all of you have a survey at your place that you can fill out and give your impressions of the event and who was the best dressed speaker and so forth. But you might also, if you would, share with us any suggestions about the emails that we do send periodically and whether we could reach you electronically in other ways. So Kelly likes my writing, but when it comes to writing at Bartlett, no one did it better than Bill Friedlander. And many of you in the room today fondly remember Bill. Bill was with Bartlett for a long time. He was our leader. Now I like to think he's our spiritual leader because we lost him in September of 2014. But he joined the firm in 1957 and was very active at the firm until shortly before his death. And no one wrote better than Bill. I had the good fortune to work with him for close to 20 years, and it was like, among all the other things I learned from him, it was like having a graduate school course in communication, because Bill could really talk about economic and investing concepts in a very succinct and unpretentious manner, and I learned so much from him. Now we're finally going to get to 2016. As we were thinking about 2016 and reviewing the year for our clients, what would be one key takeaway that would really describe the year? And as we think about all that we navigated throughout the year, it took us back to one of our all-time favorite Warren Buffett quotes. And some years back, he was interviewed, and he said, "The most important quality for an investor is temperament, not intellect." And what does he mean by that? Well, from our perspective, we think more than anything else it means a good investing temperament means one that keeps emotion out of investment decision making. And that's certainly what we endeavored to do as a firm, and we really redouble those efforts in tumultuous times in the markets. But a good investing temperament is one that is really focused assiduously on economic and investment data, really focused on the long term and tries to keep emotion out of it. We know so well as a firm that if emotion intrudes into the investment process, we are apt to succumb to temptations like market timing or performance chasing, and we know so well those can be very seductive temptations when markets are volatile. So the importance of temperament. Think about that quote. Think about temperament as you look at this next picture. We all lived through this. This is a chart of the Dow Jones Industrial Average in 2016. Now, 2015 was a very lackluster year in the markets. The markets made almost no headway. And then 2016 happened and started, and what happened? You look at the chart, if you've forgotten, those first 4 to 6 weeks, the bottom fell out. It seemed that the market fell almost every day January last year. And as a matter of fact, at the low point for the market on February 11th last year, the Dow Jones Industrial Average had declined 11%. 11% in only 6 weeks. Now, for the historians in the room, the Dow Jones Industrial Average was first calculated in 1896. You cannot find a worse opening 6 weeks in any year since 1896. It was really a tumultuous time. And you may remember what was happening at that time is that we were getting very sobering economic data out of China. It was showing that their economy was slowing, their stock market was crashing, they devalued their currency, and there was a lot of concern that this would ripple throughout the world. We might have a worldwide recession. And many market strategists were suggesting that maybe this was just the opening phase of what would be a bear market, hence our bear picture, a bear market that would take the market down 25 or 30%. So think about temperament at that time. Think about it again at mid-year. So fortunately, the market stabilized after that tumultuous start and began rising. And then at the end of June came a big surprise from Great Britain. The voters in the United Kingdom elected in a referendum to leave the European Union. This is what you now hear referred to as Brexit, the Brexit referendum. And this was a vote that was not foreseen in any polls. And it was such a shock to their government, really an embarrassment to their government, that the very next day the Prime Minister, David Cameron, resigned. And if you look closely, you'll see the markets sold off. They drifted down about 5 or 6% rather quickly. And once again, there was concern about a worldwide recession, that if Britain lapsed into a recession, that would reverberate throughout Europe and ultimately make its way to the United States. The markets pretty quickly recovered from that shock. Think about temperament again on election night. We were all watching the returns. If you're like me, you might have been flipping back and forth between different channels. And at around 10 or 11 o'clock Eastern Standard Time, it became very clear that Trump could win. And the commentators, depending on which one you were watching, why it was sensational. And the stock market futures plunged. And I remember one of the commentators saying the stock market is likely to fall 1,000 points tomorrow if this goes through. Well, we know that didn't happen, but it was certainly, again, a test of our emotions. At the end of the year, the stock market, as you know, rose throughout November and December. And at the end of the year, having started with the threat of a bear market, was very much in bull market territory. And the Dow Jones Industrial Average increased by more than 10%. But what a range of emotions along the way, and that's what brought us to that Warren Buffett quote as we began preparing for today. Kelly likes to send these emails. I write them, she sends them. I want to assure you, we do not have a predisposition to be optimistic. There are no rose-colored glasses at Bartlett. When the market got off to such a terrible start last January and February, as we studied the economic data as carefully as we could, the leading economic indicators and the various interest rate indicators, we felt very confident that a recession was not looming. It was just not, we were not seeing that in the indicators, nor were we seeing interest rate trouble. Hence, our message was rather hopeful. And we felt the same way after the Brexit surprise. But I want to assure you that the day may come when we look at the data and it tells us something else. It may tell us that the probability of a recession is increasing, and we'll interpret that as dispassionately as we can and communicate it to you and make appropriate changes in portfolios. A quick tour of the bond market last year. It certainly didn't grab the headlines that stocks did, but it was an extraordinary year for bonds as well. What we're showing on this picture is the U.S. 10-year Treasury bond. This is arguably the most important bond in the world. It's a key interest rate. If you just look at the picture, we started the year with the 10-year Treasury at 2.3% and ended at 2.5%. And that doesn't sound remarkable, but considerable turbulence along the way. Interest rates usually fall during periods where there's a lot of apprehension about the economy or during stock market scares. And so you see, noted by the red arrows, interest rates fell during that stock market scare, and they fell again after Brexit. But by year end, they were on the rise as the economy firmed up throughout the second, third, and fourth quarter, and as expectations built for perhaps a little better economic growth in 2017, interest rates started rising. It may not be as apparent here as it is with stocks, but that Buffett message about temperament is very important because it can be just as tempting to try and time the bond market as it is the stock market. And I can just think of commentators who were so fond of bonds during the scares last year and are so afraid of them now. So temperament is just as important with bonds as it is with stocks. Really taking a long-term approach. I'll close with a picture that summarizes performance for last year. It wound up being a good year for investors, particularly when you consider how badly it started. Measured by the Standard & Poor's 500 index, which is a common stock market benchmark, the U.S. stock market returned 12% between dividends and price appreciation. That's a handsome rate of return by any measure. The long-term average is about 10%, so it wound up being a very gratifying year. When the stock market is strong, invariably the bond market lags. Bonds were the performance champions in years like 2008 or 2011, tough years for stocks. Predictably, they lagged last year, but I would point out that 2.1% return, which is for an index of government and corporate bonds, still exceeded the return on cash, which is another vehicle investors often think of for safety. So it was a positive return. The one noteworthy laggard last year, and maybe this will arouse some questions later on, is that foreign markets once again significantly lagged the United States. The U.S. was the best performing stock market, and in the case of foreign stock market returns, the strength of our dollar really had an impact on the ability of investors to get returns overseas. If you look at a blend of these assets, most clients in the room, most people that we work for, individuals or institutions, have balanced accounts that'll feature a blend of all these asset classes. And a balanced account last year probably posted a return in the neighborhood of 6 to 9%, depending on the asset allocation. And by any measure, that's a very satisfying result for a balanced investor with a moderate risk level. So enough about 2016. You really came here to hear about 2017, and we have three great speakers lined up for you. Holly is going to begin with a discussion of populism. How could you talk about 2017 without talking about populism? This is a political trend that's manifested all throughout the Western world, really shaking up the establishment. And Holly is going to talk about what that means for economies, what the risks and opportunities are, and what it could mean for your portfolios. And then after Holly, we have two excellent speakers. It happens that both of them have beards. Bartlett has no prohibition against facial hair. And Chris is going to begin with a discussion of policy shifts. And we think this is very important. For the last 8 years, economic policy in the United States has really been dominated by the Federal Reserve, keeping interest rates as low as possible and using a wide variety of monetary strategies, some of them unprecedented, to keep interest rates low and fortify growth. And we see that changing now. We see economic policy going forward really changing to more of a fiscal policy approach. Chris is going to talk about that and discuss what that will mean for economies and markets. And then Brian is going to bat cleanup and put all of this together into a discussion of our investment strategy, where we're seeing opportunities across stocks and bonds and alternatives. And when Brian is through, all of us will come back here for a question and answer session, and I get the easy ones. And without further ado, I'll turn this over to Holly.
Thanks. Populism. How did we get here? At this time last year, the Iowa caucus was still a few weeks away. The establishment thought that the wave Donald Trump was riding would come crashing down as soon as voters started to hit the polls. But what the media and the pollsters didn't appreciate is that the populist wave pushing Donald Trump to the lead wasn't just your normal riptide. It was a tsunami. Now, populism has been on the rise in the Western world since the 2008 financial crisis, but it hasn't been a key topic of conversation until this past year. So before we dive into the implications of this new political reality, I wanted to spend some time really defining exactly what we mean by populism. It's a term we hear tossed around a lot, but with little definition behind it. So while there's a lot of different versions out there, all versions sort of share this idea that they are anti-establishment. They share a suspicion and a hostility towards both mainstream politics as well as other institutions deemed to be in the elite. Now, as you know, we don't typically cover political topics in our Outlook, but it was important for us to cover the idea of populism this year to really understand what it means for your money. Regardless of your political leanings, this is an important idea for us to understand so that we know what it means for investment portfolios. Around the world, we've seen populist movements gaining ground in both left and right-wing variations. Here in the United States, it's been Bernie Sanders and Donald Trump. In Britain, it was the pro-Brexit backers. In France, we saw Marine Le Pen and the National Front on the rise. We've seen it in Italy and across the rest of Europe as well. But what does this really mean in the context of our global economy? Of the 19 largest economies, 44% of the total economic output falls under populist-oriented governments. 44% is a lot of economic weight to throw around. Today I'll focus on two key topics. The first is the rise of populism, and the second is the potential impacts populism may have on the areas of global trade and immigration. Ready or not, this new political wave is upon us. Just like we closely monitor investment trends, Bartlett is watching this political trend to understand what it means for portfolios. So this takes us back to the original question: how did we get here? Let's consider what life has been like over the past 8 years for a middle-class Midwest family. We'll call them the Jones family. Mr. Jones worked for Procter & Gamble before he was laid off after the 2008 recession. And he's since found a new job, but the new manufacturing job doesn't have quite the benefits of his old one with P&G. His wife is a preschool teacher, but her salary has seen almost no increase over the past decade because school funding has been so tight. Now, the Jones family understands that the government needed to step in and save the banks during the height of the crisis, but they really don't understand how they benefited from these government policies. Now, while the Jones family is struggling just to get their income back to where it was before the crisis, they're hearing news stories about the stock market hitting all-time highs. This disparity between real income growth and the growth of wealth in the stock market has really started to widen since 2008. You can see on the chart that since December of 2008, as denoted by that red dotted line, that the divergence has been quite strong. The gold line for the S&P 500 is up 150%, while the blue line for real household income is up a paltry 2% over that same time period. We're seeing a similar effect abroad, which has led to the rise of a lot of the populist sentiment we've witnessed in Europe as well. Now, part of the rise in the stock market has been fueled by loose monetary policy, which has boosted the level of wealth for investors, especially those invested in stocks and real estate, but it's done very little in terms of real economic growth. In fact, economic growth during this past expansion has averaged just 2.1%. Dating back to 1965, growth across all periods, both in good times and in bad, has averaged 2.8%. Now, 2.1% to 2.8% may not sound like a lot, but this difference can have a lasting impact due to the power of compounding, which is really what you see here on this slide. With just 2.1% growth, it takes an extra 8 years for living standards to double. How would it impact you if you had to wait an extra 8 years to retire? The disparity between stock market growth and real income growth has really been felt the most by middle income families, where a lot of them are no longer invested in the markets. In fact, before 2008, it was reported that 3 out of every 4 middle income households was invested in the stock market. Now, that number is just half. With only half of middle income families invested in the markets, sluggish economic growth, and real income growth at just 2%, it's no wonder we're starting to see this pent-up frustration that we're witnessing today. This is really the background and the sentiment that has led to the rise of the populist-oriented wave that Donald Trump has been riding. Now that we understand where this populist sentiment has come from, it's important to think about the major policy areas that could be affected. 2 of the biggest on our radar screen are global trade and immigration. Within global trade, there's 2 areas we're watching. The first is the impact on U.S. exports, and the second is the impact on U.S. import prices. First, we'll take a look at exports. Now, much of what we hear about exports in the media is dominated by this idea of the trade deficit, or the combination of imports and exports. But when you separate out the 2, the true importance of exports becomes more clear. Within the past year, the U.S. has exported $2.2 trillion worth of goods and services. This is over 12% of our total economy. We can also get a sense of what this means for our US-based companies. Within the S&P 500, over 30% of total revenues are sourced from countries outside of the United States. And this number is even higher for a lot of multinational companies. So take Procter & Gamble, for instance. For P&G, 60% of their revenues are from countries abroad. 2 main trading relationships are on the radar screen for President Trump. The first is with Asia, which was through the Trans-Pacific Partnership that he has really made it a point as one of his first policy actions was to kill this trade deal. And the second is with our North American partners through NAFTA, or the North American Free Trade Agreement, which he's already come out and said that he's going to start negotiating with the leaders of Mexico and Canada as one of his next items on his agenda. As you can see from the chart here, 46% of our total international trade is with China and the rest of Asia. And our North American partners make up an additional 26%. So putting this into perspective, 3 out of every $4 touched by either imports or exports are impacted by these 2 main trading relationships. Now, we can't expect that our international partners will just sit by and accept many of the tariffs that President Trump was promising on the campaign trail without some sort of retaliation, whether that's in the form of tariffs of their own or other trade restrictions against US-based companies. Now, it's very likely that the administration will temper a lot of what we've been hearing before it actually goes into action. But it's important to recognize that we no longer live in an isolated world. And we would caution against the idea of trade deals that can severely hinder growth by closing off our US marketplace. Now, the second way that trade deals impact our economy is through import prices. Higher tariffs will tend to hurt middle and low-income consumers the most, who buy more of the low-cost goods manufactured abroad. So going back to the Jones family, before 2008, they enjoyed shopping at local farmers markets and buying products that were made in the USA. But since the recession, they've had to change their buying habits. Now that the budget is tighter, they tend to shop at places like Walmart, where the goods are imported, but they tend to be less expensive. A higher tariff on imports would increase prices, making it more expensive for Mr. and Mrs. Jones to buy their everyday products. Now, this relationship is important because it can impact both consumer spending as well as earnings for our US-based companies. Almost 2/3 of our economy is based on consumer spending. If we see a pullback in consumption due either to reduced consumer spending or impacts on US earnings from lower sales abroad, it could lead to lower economic growth and even an eventual recession. Now, as it relates to investment portfolios, we're closely monitoring the effects these changes may have and what it means for corporate earnings. And Brian's going to dive into a little bit more detail on that strategy section in just a bit. The second major policy area impacted by the populist sentiment is immigration. One of the rallying cries of the populist movement has been an anti-immigration stance. We would caution that a hard line against immigration can ultimately backfire and lead to lower economic growth. As you can see from the formula here, the formula for economic growth is based on improvements in worker productivity plus growth of our labor force. If we shut off our borders, we're losing one of these primary drivers of growth. On the flip side, our economy cannot handle an immigration policy with no boundaries at all. So it's going to really be a difficult task for our new administration to find a balanced policy that promotes growth while also supporting the American worker and our current economic system. The populist wave is a relatively new force hitting our political system, which will ultimately impact our economic policies, especially as they relate to global trade and immigration. Now, we don't know exactly what the new administration will do. I'm sure eventually we'll find out via Twitter. But whichever direction it takes, Bartlett has ridden that wave before, and we're ready to navigate the future ahead. What this populist sentiment ultimately boils down to is the need for economic growth. It's this desire for more growth. If we would have seen 4% growth coming out of the 2008 recession, it's highly unlikely that we would be experiencing this rise of populist sentiment that we have so far. I'll now turn it over to Chris Robbins, who will dive into the growth-oriented economic strategies we may see and the implications of those policies.
So Holly talked about populism, what it means, and what some of the risks are, like a decline in global trade. The current environment lends itself to some important policy shifts, some of which might have a positive impact. The two we're likely to get are fiscal stimulus and tax reform. This is a cartoon of Federal Reserve Chair Janet Yellen carrying the world on her back while walking a tightrope. A community of spectators anxiously watches her below. Since the financial crisis, the Fed, which is the creator and controller of our currency, has been doing the heavy lifting with monetary stimulus, which involves things like keeping interest rates low and printing money to buy bonds and investment securities. We've come a long way since then. The market has come a long way, and unemployment has come a long way, and Fed Chair Yellen is reaching the end of her tightrope. Fiscal stimulus is government spending. Does anyone remember the word austerity? Austerity? Austerity was a buzzword, and it's an artful way of saying fiscal conservatism. And it was a word that was just used to describe the spending policies that were popular when economies were subdued following the economic recession. You couldn't watch a television show related to finance or read a financial newspaper for a period of time without hearing or seeing the word austerity. What's important to understand is that the environment we are in now means that austerity is out and government spending is in. So, if we're going to get some spending, how much might we get? This is a look at government spending as a percentage of GDP. And right now, we're right around 21%. You can see back in 2010, it was closer to 24%. Our belief is that we could very easily get back to where we were just a few years ago and beyond. Now, an increase of a couple percent doesn't seem like a lot, but in dollar terms, if we were to get back to where we were just a few years ago, it would be substantial. It would be close to $500 billion, which would be meaningful for our economy. And we wouldn't have to be too creative to spend that kind of money. In fact, all of that could go to infrastructure projects. According to the American Society of Civil Engineers, these important areas of infrastructure spending fall short. So for things like surface transportation, electricity, airports, and water, the funding gap is in the hundreds of billions of dollars. What does this mean for your money? Bartlett believes an increase in inflation is likely. This isn't just our belief, the market believes this also. This is a measure of market-based inflation expectations and how those expectations have changed over the past year. You can see just a short while ago, they were close to 1.6%. Now we're closer to 2% in a short period of time. If we get the kind of government spending and fiscal stimulus that we expect, this trend is likely to continue. Now, when we talk about inflation increasing, sometimes people ask, what if that causes interest rates to increase? And if that happens, what does that mean for the bonds that I own? A point we want to make is that bonds can still perform reasonably well in a rising interest rate environment. During the past half decade, we had a secular period of interest rates increasing, followed by a secular period of interest rates decreasing. Not surprisingly, bonds did better when interest rates were coming down. But it's interesting to note that a traditional bond portfolio still returned just over 4% during the period when interest rates were rising. Interest rates are a double-edged sword for bonds. As interest rates go up, bond prices tend to go down, but keep in mind bonds mature. And when they mature, if interest rates have gone up, that cash can be reinvested in bonds with higher yields. So it's not all negative for bonds. Even if we get some interest rate increases, some inflation, bonds will remain an important income generator and shock absorber in investment portfolios. It's also important to note that in the late 70s, when the 30-year Treasury yield was at 14.5%, and the Joneses were paying something close to that on their mortgage, inflation was close to 10% at that point in time. And we don't expect to be anywhere near that. We expect an increase, but we don't expect to be close to where we were during that unusual time. The other important policy shift we're likely to get is tax reform. It's not a secret that the United States has had the highest combined corporate income tax rate of the developed world for a long period of time. There's been a lot of pressure for that rate to come down. The missing piece for that to happen was the political environment where it was likely to happen. We seem to have that now. So if we get lower corporate taxes, what does this mean for your money? Well, lower corporate taxes means higher profits for a lot of companies that you own in your portfolios. When taxes are cut, it flows straight to the bottom line. But it's important to know that smaller companies and companies that are domestically focused will be likely to receive an outsized benefit than larger companies and multinational companies. For example, if you consider a company like General Motors, which gets just under half of its revenue from outside of the US, it pays an effective corporate income tax rate of about 22.5%. A domestically focused company like TJ Maxx, which receives close to 80% of its revenue from inside the US, pays an effective corporate tax rate close to the highest combined corporate tax rate of 38%. So know that in general, lower taxes is good for companies, but it's likely to impact some companies more than others. Along with the possibility of lower taxes is a tax holiday on overseas cash. United States companies have a tremendous amount of cash parked overseas. These companies earn money all over the world, but they don't repatriate the cash because of the tremendous amount of taxes they would have to pay if they did that. In fact, companies like Apple and Microsoft, even though they have hundreds of billions of dollars in cash, they still borrow money because it's much cheaper to pay the coupons on the bonds that they issue than to pay the taxes on the cash if they were to repatriate it. If we do a tax holiday on overseas cash, it wouldn't be the first time we did it. In 2004, we let companies bring their cash home at a temporary rate of just over 5%. Shareholders of these companies received a benefit in the form of increased dividends and share buybacks. We would expect a similar outcome this time. The difference between 2004 and now is that back in 2004, companies had $600 billion parked overseas. Now they have $2.5 trillion parked overseas. So again, in general, this would be a very good thing for companies and a good thing for stocks, but it's likely to affect some companies more than others. This is something that we're scrutinizing when evaluating companies for investment portfolios, and it's something that's likely to be increasingly important over the next year. So, in summary, fiscal stimulus is likely. That might result in some inflation, but don't allow that to scare you out of bonds. And secondly, tax reform is on the horizon, which in general will be good for companies and good for stocks, but it's likely to impact some companies more than others. When evaluating investments, we look at a lot of different things. We look at valuation, we look at economic metrics. And to talk about those things in our investment strategy for the coming year, I'll turn it over to Brian Antonucci.
Well, thank you, Chris. As Jim mentioned, I'm the second professional with a beard, so I hope that's okay. My wife says it's slimming. So to be ready for 2017, we've done our homework. There are three main themes that we want you to take with you today. First is that based off the data we see today, the U.S. should not be entering into a recession in 2017. Secondly, is that based off of the data that both Holly and Chris mentioned, there's going to be a lot of political uncertainty that comes to the forefront this year. So we're expecting higher volatility, but not a bear market. And the third point is that based on all of our research, we prefer stocks over bonds and alternative investments in our investment portfolios. So all the data that we analyze is viewed similarly to a traffic light. There are green light indicators showing a positive trend, yellow light with a cautious trend, and red light showing a trend in decline. These indicators are objective, dispassionate, and have no political influences. So we'll start out with the leading economic indicators. There are 10 indicators showing a positive trend in growth. The second positive indicator that we're watching is the rebound in corporate profits this year. They've been declining since 2014, and we're now seeing prospects for growth in 2017. And lastly, 2/3 of our economy is made up by the U.S. consumer. Currently, we see the trend in the consumer to be strong with a growth in confidence. We'll go into more detail on that in a minute. Now, I'm not allowed to point out this gentleman in the audience, but we do have someone locally that works for the conference board. So we're going to use some of their data in our presentation. And this is, again, an objective data source. Now, what you're seeing in the blue line here is an index of 10 leading economic indicators. And it tracks over time. And what's important is the gray bars indicate periods of recession. And these leading economic indicators will flatten out and start to turn down about 6 to 12 months before the beginning of a recession. Well, currently, when you dissect the indicators, 7 out of the 10 of these indicators are showing a green light of continued growth. So this is positive for the economy. Now, typically, if there's a 5 to 10% correction in the market, Warren Buffett usually gets interviewed on TV. And they ask him, what do you think about the market? And he requotes his mentor, Benjamin Graham, who says, the stock market in the short run is a voting machine, and in the long run is a weighing machine. Well, corporate profits are the fundamentals that get weighed over time. Now, this chart shows quarterly profits of the S&P 500 going back to the late 90s. The red line is the trailing 1 year of this number. Now, the red line looks a little bit like a roller coaster as it rises and dips and rises and dips. Well, and typically these dips are because of an economic recession. Since 2014, you can see the red line starting to turn down. Well, corporate profits have been starting to turn down because we've had a 50% fall in energy prices, a strong US dollar, and very low interest rates. Now, some of these headwinds are starting to subside. And looking into 2017, you can see the gold bars. These are the expected earnings for the S&P 500 for the first few quarters of 17. So we're expecting high to mid-single digit earnings growth this year. Consumer confidence. Again, this is another conference board indicator. Consumer confidence is very important to us because the more confident the consumer is, the more they're going to spend. So rising home prices and low unemployment have been the main drivers for continued confidence since the recession. Now, when we look historically, this indicator is important to us because of, as you can see in the red dots, or the red circles. About 6 months before the beginning of an economic recession, consumer confidence will start to turn down. You'll see unemployment start to pick up, and they're going to find ways to start to lose confidence. So currently, the trend has been very positive, especially the last 6 months with a very positive trend in consumer confidence. So just to recap the 3 positive indicators that we're watching, the leading economic indicators suggest continued growth. Corporate profits are on the rise for 2017, and the consumer is strong. So now on to some areas that we're watching closely. First is the developments that Chris and Holly mentioned. There's a lot of political uncertainty out in the market. Reform of the ACA, change in certain regulations, repatriation of cash overseas, lowering the corporate and personal tax rates. Well, since the election, the stock market's up over 6%. A lot of this got priced in very quickly. How much of this is actually going to come into fruition? Well, we're not anchoring our beliefs in any of that it will actually happen all this year. Nothing from the campaigns ever come into fruition the first year. It takes time. That's the way our government works. So we're certainly watching the tweets and all the other data that's going to come from that. Secondly is valuations. Bartlett has prided themselves as stewards of wealth by purchasing attractively valued stocks and bonds. And currently, valuations are on the rise and getting to levels that we're less comfortable with. And lastly, and probably most important, the red light indicator that we're watching is rising rates, and more importantly, rapidly rising rates. So to start into what do we think of the market? You know, the Dow briefly touched 20,000. Stock market is near all-time highs. I imagine that's why many of you are in the room today. So how we determine whether the market is overvalued or undervalued is by this measure. It's the price to earnings ratio. And it goes back to the late 1950s. 70% of the time, the price to earnings ratio stays in between these 2 gold dotted lines. A few times, as you can see during the tech bubble in the late 90s, it became an overvalued territory. And more back in the late 70s and early 80s, it was undervalued. So now we're starting to trend higher, and as you can see, 21 times trailing earnings. It's above the historic average and is giving us some caution. Jim mentioned the S&P 500 return of 12% last year. Well, we had 0 earnings growth and a 2% dividend yield. So the rest of that 10% came from expansion in the price to earnings multiple. And that's what we're starting to get concerned about. So there's good problems and bad problems about rising rates. We'll start with the bad news first. For both consumers and businesses, higher interest rates means higher borrowing costs. In the last 10 years, chief financial officers of the S&P 500 companies have doubled the debt on their balance sheet. It was $600 billion, and now it's $1.4 trillion. So if we have rapidly rising interest rates, the interest cost is going to be higher for companies, which is going to hurt their profit margins. Similar for the consumer. If the Jones family that Holly mentioned has another kid and they want to go out and buy another home, interest rates go up, they're going to be able to afford less of a home with the same amount of income. So that's the bad news for interest rates. The good news is that savers, like most of you in this room, are going to get higher returns on your cash and bonds. It also is, rising rates are usually attributed to better economic growth. When we look at the stock market and how it performs during rising rate environments, we look at the last 6 periods. 5 out of the last 6 periods, the stock market has had a positive return during a rising rate environment. And it was only during a rapidly rising interest rate environment of 1993 to 94 did we see a negative return for the stock market. So again, to recap the areas that we're concerned about, the political volatility, the rising valuations in the US, and rapidly rising interest rates. So how do we protect our clients from some of these uncertainties that we're seeing? Well, as Jim mentioned in his review of 2016, the first 6 weeks of last year's market were excruciating, where the market was down 10 to 15%. Now, Bartlett invests in bonds and alternative investments, and during that same time period, these were up over 1%. So that was the protection that we needed. Therefore, if we're wrong on our economic forecast of continued growth, bonds will help protect our clients' portfolios. And alternative investments have different price returns that are different than the traditional stock market. Now, everyone in this room could have a different asset allocation. So there's a wide spectrum of the most aggressive portfolios that are going to have all stocks, they want the most return, but are also going to take the most amount of risk. And on the other side, there are clients that want to take the least amount of risk and are going to own mostly bonds. Now, for younger clients, they're going to have the riskier portfolios. And typically, for clients as they're into retirement, are going to have the less risky portfolios. So this sample portfolio I'm about to show you is basically in a silo. It's a model that we manage for an average client. And our recommendations for 2017 for this average client is to have 65% in stocks, 29% in bonds, 5% in alternatives, and 1% or minimal cash. We have a strategic asset allocation committee that's dedicated to managing this model and the asset allocation changes. Since 2014, the asset allocation in equities was about 72%. And as corporate profits and some of these yellow and red light indicators started to come into the market, we brought down the equity allocation to 65%. So as we see more yellow and red light indicators come into the market, it would give us reason to move this down even further. Diving in a little bit further into our equity recommendations, within an equity allocation, about 80% is going to be invested in US stocks. And we think a focus on domestically oriented companies is even more important this year than it was last year, for many of the reasons that Holly and Chris mentioned. If international trade deals get renegotiated, there's going to be a lot of volatility in the international markets. And as Chris mentioned, changes to the tax code will help the US companies. The possibility of repatriation from cash from overseas markets will help US companies as well. Now, our focus is on companies that have strong visibility into their earnings and dividend growth. We want companies that are of quality, which means high profitability and very strong balance sheets. Therefore, if interest rates do rise and we have tougher economic conditions, these companies will be better protected. Therefore, our favored sectors for the year are technology, consumer discretion, and healthcare stocks. Technology, such as an Apple, will benefit from repatriation of cash overseas, but they also benefit at this point in the cycle when companies start to make more investments in technology. So Oracle and Microsoft will also benefit from this. Consumer discretionary companies, we're going to invest in specialty retailers, so not just any retailer, but specialty retailers, and one example is a TJ Maxx. We also like select media companies, and our favorite is Disney. Healthcare was the worst performing sector last year. It was down, and obviously with the election, healthcare isn't going to do well when healthcare is in the news every day. Now, our healthcare analyst, James Lewis, points out that healthcare sector is the cheapest that it's been relative to the market since 2008. Now, we would recommend staying away from some of these stocks in terms of managed care companies and other insurers, but we do like some select biotech companies, and Amgen is an example there. Now, in bonds, our recommendations are to focus on intermediate corporate bonds. These bonds are yielding about 1% to 2% higher than intermediate government bonds. And it's for certain particular clients. Some are going to use municipals, but we're currently favoring corporate bonds right now. Now, as Chris mentioned, if inflation is on the rise, how can we help protect our portfolio? And that's by investing in Treasury inflation-protected securities. These are government bonds that pay out a return tied to the rate of inflation. So therefore, if interest rates rise and are higher than they are today, you'll have a higher return. And this helps hedge your portfolio. So to conclude, the data as we see it today would not suggest that we're going to enter into a recession in the next 6 to 12 months. The consumer is strong, and the leading economic indicators would not recommend that, would not suggest that. Given the political landscape, we're expecting higher market volatility. Obviously, as we've seen in the new announcements and every tweet that comes by, there's going to be more volatility in the market, and that can be opportunistic for us. And based on all of our research, we continue to favor stocks over bonds, alternative, and holding cash. And with those concluding thoughts, I'll invite Kelly and the rest of our presenters to join me on stage. Thanks.
Thanks, Brian. So what we'll do is we've got about 10 minutes for questions, and then I'll do a wrap-up. But I wanted to remind you all that there are cards on your tables with a brief survey. We'd appreciate it if you'd fill those out. And also, if we don't get time to get to your question, you can write that down and somebody can give you a call. So I think what I'll do is start out with a first question for Brian. I got this question from a client the other day, speaking of healthcare, who said, what are your thoughts about repealing the Affordable Care Act, and what direct impact will that have on those healthcare stocks that I've held in my portfolio for a long time? So. Okay.
Well, we think the key to the repeal of the ACA would be to have more competitive insurance markets, crossing states. That would really be beneficial to the future of healthcare and healthcare insurance. The way that we invest is really to exclude the impacts of the ACA and make sure that we're investing in companies that have proven and distinct product lines. And again, an Amgen would be a great example of a well-established company with a wonderful product line.
Okay, so we have in the back Reagan, who has a microphone, and Courtney over on this side. So if you raise your hand for questions, they can come over. It's a big room, and we want to make sure everybody can hear. So.
Kelly, would one of you give us an example of an alternative investment?
Sure. So, yeah, right. So not everybody in the room uses alternative investments, and it's a broad range. So what is an alternative investment?
That's an excellent question, and you're right that it really means a lot of different things across the marketplace, across different providers and media and things like that. But the way that we think about alternative investments at Bartlett is we're always looking for opportunities where they're going to act differently than stocks and bonds. So really that it has almost no correlation to your traditional asset classes. So one great example of this would be reinsurance bonds. So a reinsurance bond is tied to the impacts of weather. It's basically insurance on insurance companies. But it's not going to move around because interest rates go up or because the stock market moves. It's uncorrelated to that, but it pays out a really handsome dividend yield and has a decent appreciation over time. The other thing that we are looking for is to make sure that the fee structure is attractive. So, we hear a lot in the news about hedge funds and private equity firms that are charging 2% plus, in a return on your earnings. And what we're looking for is a structure that's more like a mutual fund where it has attractive liquidity and they're not charging exorbitant fees, which a lot of the accountants in the room will appreciate that, most of our investments don't require an extra K1 or anything like that. So if you have additional questions, we encourage you to follow up with your advisor and we'd be happy to go over some more ideas.
We have a question up here, Courtney.
With all the talk about reduced corporate taxes and reduced personal taxes, to quote somebody, I think both will be huge. How does that juxtapose against the vastly increased spending that will need to be done for things like infrastructure, as indicated on page 10 here? How do we pay for that?
Right, so it's a great question with the potential of reduced corporate and personal income taxes, and you saw the $1 billion or so at a minimum spending on infrastructure. How do we do that?
In a word, we borrow. You've heard of tax and spend. I think we'll have borrow and spend. I think it's safe to say. And the president, whose career was in real estate development, very comfortable with debt. And interest rates, even though, as Chris showed you, have been on the rise lately, by historical standards are still very low. We're at interest rate levels that last prevailed for a sustained period of time when Truman and Eisenhower were in the White House. So I think his view and the view of his team would be that as long as interest rates are low, we'll borrow. Some time ago, Barron's ran a fantastic 5-part series earlier this year, a 5-part series on ways to get the economy going again. And one of the things they were advocating is that with interest rates this low, we oughtn't stop at issuing 30-year bonds, which is traditionally as far as we go with treasuries. We ought to be issuing 50 to 100-year bonds. And some very smart companies have done just that. And so I think we'll see more borrowing. And that's one reason that you may eventually get some upward pressure on rates. And Chris knows more about fixed income than I do, so he may have something to add to that.
I would say the exact same thing. I would say that deficit spending is something that is expected, and I think the market is implying that there's some expectation of higher deficit spending.
one other thing I'd add, Chris talked about infrastructure. If it's done well, and it's a big if, we admit that, but think of the Eisenhower program in the 1950s and 60s that had a fantastic payoff for the economy, remarkable improvements in productivity. That was a very, very forward-looking program. Infrastructure, this is government spending that has a significant return on investment. So if you kind of put your CFO hat on and you're able to borrow at 3 or 4%, maybe issuing 50 to 100-year bonds, what's the rate of return on a good infrastructure project? So I think they'll think of it that way too. But does that get at your question?
I know there have to be a few other questions out there.
I actually have two, and they're sort of unrelated. First of all, what's your outlook on energy prices and the impact that that's going to have on the U.S. economy and maybe the world economy? And secondly, you don't seem particularly bullish about international stocks. And by that, I mean not U.S. multinationals, but foreign companies. Are there, and I understand why, but are there any bargains there where if you're going to allocate 20% of your equity allocation to those, you might be able to hit a home run?
So we have two questions. One about energy prices moving around and what does that do to our energy stocks? Who wants to take that first?
I'll take the energy one, and the international one's harder, so Brian will take that one. Gray hairs give you some privileges. Jim, in terms of energy, there's been a lot of enthusiasm. In the last month, we saw a significant agreement among the OPEC countries to limit production, and then that agreement was joined by key non-OPEC producers. But it remains to be seen whether the cartel will live up to those production cuts. That's easier said than done. And then secondly, OPEC isn't what it used to be. And arguably the most important swing producer in the world is the United States. And so think back to when oil was below 30 a barrel, when I was reviewing 2016 and things looked so frightful. A lot of these domestic companies in places like North Dakota and Colorado and whatnot shut in production. And that's pent-up production that is now coming back on the market as economic growth plus OPEC has engineered this recovery toward 50 a barrel or higher. And so we view that reservoir of supply that's out there ready to come back on stream as a restraint on oil prices. And I should say predicting oil prices is a little like predicting interest rates or where the market's going. You can look foolish, but we would hazard the educated guess that we're not going to be back on our way to $75 a barrel. That maybe where we are now is as high as it goes. And then the international one was tougher, so Brian will take that.
Great. Yep. Thanks, Jim. So when we talked about valuations earlier in the U.S. market is the most highly valued. And so looking at international markets, it looks more attractive. It's trading a couple multiple points lower than where we are here in the U.S. And emerging markets are trading 2 more multiple points below that. So the international markets are cheaper than we're seeing in the U.S. So we can't really time on when the international markets are going to turn around. Over the last 5 years, they've been a drag on performance relative to the U.S. markets. But you go back the decade before that, and they were the best performing asset class. So we have a allocation to international, and I do think we'll continue to be opportunistic as we had the Brexit, volatility in the markets, and there's going to be more volatility in the international markets. Might give us an opportunity to add to those positions or find companies, in Europe and in Asia that are going to get upset by some of the trade policies that start to have more volatility. So, yes, it's a great question. We didn't talk a lot about it, and it's not a favored sector for us because of a lot of the headwinds. The unemployment rate, especially in Europe, is 10%. It's under 5% here. So it's just a comparison to where we are versus where they are. Great question.
Carolyn.
Back to the infrastructure question, there's been a lot of talk about public-private partnerships to extend and add some oomph to the federal money that might come into those projects. Where do you see the private money coming from? China, Japan? Do you see new companies developing here in the States to do some of the large projects if we get into rail projects or some of the large bridges?
Yeah, that's a really good question, and it'd be interesting to see how we end up with the public-private partnership. So which one of you wants to take that?
It's a great question, and I'll just humbly say we're not sure. We're monitoring that closely. If you think of something like rail transportation, there's a brilliant guy in Omaha, Warren Buffett, owns the Burlington Northern Santa Fe Rail under the Berkshire Hathaway umbrella. And if there's any sort of public-private partnership around infrastructure spending in rail, you would certainly think that they would be a factor. And then some of the other major companies, whether in the energy or chemical industries or some of the companies that are involved in construction. But we're watching that closely. That's something that just hasn't been fleshed out. There was even some talk I read somewhere on this repatriation idea that to the extent companies repatriated at a lower rate, they might even get a more preferential rate if that were reinvested in infrastructure. And that sounds a little complicated to me. It remains to be seen how that'll be fleshed out. But it's a great question, and it's something we're watching. And Chris is nodding his head, so he agrees with what I said. That's usually a good sign. But I hope that gets at your question somewhat. It's something we're watching closely, and we really need to see more data and more meat on the bones of this policy talk.
Okay, one more question and that's it. Is that okay, Catherine? This will be our last question. Oh, sorry. Okay. I didn't see you over there.
Well, thank you. I'm actually here on behalf of my employer, and you all have done a fantastic job of helping me to really understand how the market operates. The one question that still lingers in my mind is I understand the pros and the cons of the interest rate, but what really affects the interest rate? What drives it up? What drives it down?
Okay, great question. What's happening now to drive market interest rates up or down? And I think that's a Chris question.
Thank you. That's a great question. So there's a couple things. I think it's important that we differentiate between short-term interest rates and long-term interest rates. Short-term interest rates are controlled by the Federal Reserve, which is the creator and controller of our money, essentially. And the reason they control short-term interest rates is to influence a little bit of what goes on in the market. And so when times are bad, they like to lower that, and so it's to make it stimulative for the economy. So that is intended to make it cheap for companies to borrow money, for example. When things are good, they tend to increase that short-term interest rate, and that's actually happened here in recent times as the economy has improved. Longer-term interest rates tend to be based off of growth and inflation expectations. So what will economic growth look like? What will inflation look like? And so as people and as market participants start expecting more growth and more inflation, that could cause long-term interest rates to go up from where they are. Conversely, if all of a sudden we get some sort of economic shock or we start to see signs of a recession, then those long-term interest rates could go down. So long-term and short-term interest rates can be doing different things at different times, but those tend to be the biggest drivers of interest rates.
Dave Hendy, this is the last question. He's right up here. Oops, press the button.
Can you hear me okay? There have been several articles recently in the Wall Street Journal where they say there's 4 items, Social Security, Medicare, defense spending, and interest, that make up 86% of all federal spending. Is it likely in this environment that Social Security and Medicare will be, those big entitlement programs will be changed or reduced?
Yeah, so what will happen to our Medicare and Social Security? Do you want to take that?
So typically when you see a Republican administration, we hear a lot of things about we're going to cut spending, but going back to this idea of the populist wave that really pushed President Trump into office, it was from a lot of people who feel left out and who are depending on their Social Security and are depending on Medicare when they reach retirement. So at this point, it doesn't seem that those are on his radar screen to be cutting. In fact, along the campaign trail, he said we need more Social Security. Now, there are definitely ways that down the line, you could make tweaks to the formulas around Social Security that would help sustain the program for the long term. So for instance, instead of the retirement age being 66, as it is right now, a few years from now, it's going to be 67. And in my mind, I hope by the time I retire, it's 70, because that means that we're making some progress there. So there are definitely ways that we can tweak the program, but at this point, we don't foresee the administration making some sort of change that would impact current retirees. What about Medicare? That's a good question. That falls more under the ACA and, you know, some of the changes that they're going to be making in terms of those policies, and I think that's sort of a bit more up for debate. It still goes back to the idea that I really do think that this administration wants to let the people know who put them in office that they're kind of watching out for the little guy. So it's unlikely in the near term that we would see any sort of big cuts on that. They seem more to be okay with spending, as my colleagues have mentioned in other ways, than your typical Republican administration.
Well, ready or not, 2017 promises change. And to help you understand where we've been and where we're going, Jim reminded you of how we made it through an incredible 2016 with surprises and a lot of volatility. Holly talked about the growing trend of populism and the potential economic impact on global trade and immigration. Chris talked about the big shift from monetary to fiscal policy, and that even in this rising rate environment, not rapidly rising rate environment, don't be afraid of bonds, holding bonds or buying bonds. And lastly, Brian wrapped up and told you that given what we know now at this point, we do not expect a recession in 2017, and that we continue to favor stocks over bonds. So hopefully this gives you some peace of mind. If you need a deeper dive, all of us will be around afterwards, so you can give us more questions. But we really thank you for your interest today in Bartlett's perspective on 2017, and we thank you all for your trust and confidence in Bartlett. I'm not quite done yet. So know that we are ready to navigate any of these unexpected challenges that come from the economy and from the markets that they may throw your way and ours. The question is, are all of you ready? Thank you for coming today.